Today we'll be looking at 5 specific topics: the S&P 500, XBI Biotech, XLE Energy, the XLC Communications ETF, and then the MAGS ETF as well. So let's start at the top, the S&P 500, of course, and let's focus on the patterns because we have a pattern battle going on. A lot of different shapes to keep track of here. So let's start with this bullish flag formation, which has now been in play for just about 2 months. We saw the breakout here on April 24th. It is now Tuesday, June 23rd in the afternoon. So it's done a very good job of extending almost immediately and getting very close, within 1% of achieving that 7680 target. So we didn't quite get there, but we stated at the time that at some point we have to understand there was going to be some two-way volatility. And because of this extension, it created this big cushion of which it could back and fill and eventually, hopefully, right itself before enduring a lot of pain, thereby keeping this bullish pattern target in play. And of course, that is exactly what has happened so far because it has been quite a ride, at least over the last 2 weeks, right? We talked about how there's so many 1% moves, right? 6 in the last 10 sessions, not including today's action. And so that's just a lot of infighting between obviously aggressive buyers and aggressive sellers. But in the meantime, this is all happening very close to its highs and still staying away from violating this pattern. That's important because, again, this is the cushion that it's created. And so we have to just respect this for as long as it stays in play. Now, there are also a few potential bullish patterns as well. Now, I wanted to start with what this looked like right when we had that first really big downturn, remember, on June 9th, right? Market was down a large amount, one of the first 1% declines you've had in quite some time. And so anytime that occurs, try to understand, like, where is it going to stop, number one? What will it look like when there's a first rally attempt? And so we always try to, put in some potential scenarios where that happens. And so a potential bullish scenario, of course, would you see an immediate buy near this low, push back to the high or near the highs near 7,600, maybe form a higher low from there, and then break out. So of course, we knew that wasn't going to happen exactly, but this is the type of thing we wanted to see play out after such a big downturn like that. And so we then go 10 days later, June 15th. That was the initial flush right there. Of course, that wasn't all of it. Had some more downside action, more of a bounce, almost all the way back to 7,600. So if that were to play out, of course, a higher low could develop around here and then a breakout. And we know that didn't occur either. So now, as of about noontime on June 23rd, what do we have now? We have a market that opened up decidedly lower, led by, of course, or lagged down by large cap tech. But early on, at least, we saw some buying. And so now we have maybe another iteration of a bullish pattern as well, where we don't even need to see a breakout to new all-time highs at this point, just connecting the area, say here, around 75, 50 or so, where the last high was, and that could be a bullish pattern. Come back to next week, or the week after this could look completely different again, but it's important to track these because eventually we may get a breakout while not many people are expecting it. So we have to be on guard for that. We can also look at this in terms of trading boxes, right? And we have this colored in green because this is, at least from this point of view, neutral, right? We saw potential breakdown, which we just talked about. We saw the move close to 7,600, didn't quite get there. Now the pullback again. And these are all those 1% moves just over the last 2 weeks or so. And so we can just categorize this as a trading range for now. And we know along the way, we've had 3 straight trading box breakouts all the way up to the beginning of June. When that rally failed up here, of course, it turned into a bearish or a trading box breakdown. And now we have one other one forming as well. Now, we could look at this in a different way and basically categorize all this action going back to the middle of May as one big trading range. And if this doesn't really play out in terms of getting a breakout or a breakdown, we may have to call it that. We saw what happened back here. We don't have all the price action pulled in here, but going all the way back to the beginning of the year, really talking about 2.5 months worth of back and forth movement before we had emphatic break to the downside here. Now, there are also some potential breakdown scenarios as well, right? And so we could look at this as a symmetrical triangle pattern, but with it occurring after such a big move, we can very easily see a break below this uptrend line be a downside break, and we can start measuring it from that angle. But right now, we haven't had more than 1 day of a follow through to the downside. So that's important to realize. Another way to look at it, as we've talked about recently, is we're calling this a diamond formation. Now, these are typically rare because a lot has to happen for something like this to take shape, right? We can't even see, these are higher highs, higher lows, but then of course lower highs around here, but still higher lows. And so we put a nice box around this, and it's a diamond pattern. Sounds cool, of course, but what does it really mean? Well, when these occur after a pretty strong up move, they're most of the time considered potential reversal patterns. And you can understand why. Very consistent one-way action turns into volatility near the highs, inability to make a new high. Along the way, a lot of fighting, right? A lot of battling between bulls and bears. And when that type of volatility occurs after a big up move, sometimes it just wears in the patience of buyers that had been immediately rewarded all along the way here. And so eventually could see this move much lower from there. And again, seeing that occur after we were just talking about it for 2 days with a downside break on Tuesday could lead to more of the same. But there's been a missing ingredient to these bearish patterns so far, and that is downside follow through. Again, it's only 1 day for now, but we've seen this occur before. So numerous bearish patterns take shape near the March lows, and anytime there's a consolidation from this point, we can call it a potential bearish formation. We need to see downside follow through, not just 1 day, more days, and obviously we know how that can turn into a waterfall decline. We've seen it before. So if you're enjoying this content, again, I urge you to check out Kappa Notes, our free Substack newsletter. Again, we put on excerpts of our premium pieces multiple times a week, including this morning talking about how the big moves are not slowing down. Also profiled a number of potential stopping points in case this turns into something more substantial. We also highlight a key chart trade idea that we talked about last week to our clients in the medical diagnostics field that is actually enjoying a breakout today, even as most of the market is rolling over. So again, check it out here on capnotes.substack.com. Look forward to seeing you there. So let's turn to XBI Biotech, which obviously has been doing very well. It's breaking out from this most recent bullish pattern. The second one we've had now in 2026. The first one, just as long, got the breakout, but didn't quite get there. It occurred right in the middle of April. That wasn't one that buyers really liked to see, at least by how it played out. Got a rollover, violated the breakout zone, but instead of rolling it over completely, what did it do? Started to form another very similar looking inverse head and shoulders pattern, got the breakout, and it's had 4 straight up days of follow through and actually already achieving the short-term target of 148. And so on a short-term trade, could have taken the profit with that small, but of course, that's sometimes how we use bear or bullish pattern breakouts. At the same time, it tells us that, it's been an uptrend for a while right now, and continuing to reward bullish patterns even after a strong run, that's important to realize because it can help the longer term picture as well. And so it's breaking out, but it's also extended now on a short-term basis because it's now getting close and actually pushing through the top of this upward sloping channel, just as it gets back to overbought territory. The last time that occurred, as we can tell, as highlighted by this vertical red line, was in the middle of April, just 2 months ago. And that led to not a huge amount of selling, but some consolidation, downward pressure, at least for a few weeks before the next bid returned. But we've seen this before as well. Whereas last time we saw an extended upward sloping trading channel take shape was from May through September 2025, where the first time that the S&P was, or that the XBI was testing the upper threshold of this particular pattern was in early September, when it also hit overbought for the same time. And while it was unable to punch through that initially, it did not slow down at all. In fact, when it had its first breakout attempt through that upper line, provided a breakout. And that breakout, of course, led to another up leg, which really we're still in right now. So let's not look at this and say just because it's broken out, it has upside target, is overbought, doesn't mean that the end is near. What's been showing, of course, that its relative strength over the last few months has been rewarded over and over again. And so we have to align ourselves with areas like this that are still showing breakouts, that work, showing relative strength, that continues as well. And so it's also following the long-term blueprint, meaning that we saw this type of action before in 2020, 2021. Now, this one happened much quicker, right? Up 180% from COVID, March 2020 low, all the way up to February 2021. So if we go back to here, this was the tariff tantrum low in 2025. We're now, again, more than 15 months or so into this, and still obviously more to go. We don't think that this particular blueprint is going to be followed this strictly on an ongoing basis, but what it does show is once it gets that breakout through some key areas here, after some really tough years before this, momentum has come back and it continues to be bought even at higher prices, and that's something we shouldn't ignore. So let's turn to XLE Energy. And as we know, with crude oil coming under pressure over the last few weeks, XLE has as well. So number one, it's been breaking down through this very clear bearish formation, right? It took a little while to form. As we know, a lot of back and forth movement. Weakness was bought. Strength has been sold over and over again until finally got that gap down last week, follow through. Now, the last 6 trading days have all been taking place beneath this key 56 breakdown zone. So that we need to respect that, right? Especially even after getting a few days of buying, seeing how it does right here is going to be very important because, again, we have to trust any breakdown or breakout for that matter for as long as it remains in play. And so if we look at the XLE versus the S&P 500, there are lower lows in place as well as we'd imagine, but there's also a positive RSI divergence that we should not ignore as well. This is a daily chart that shows all of the action, XLE versus the S&P 500 on a relative basis. And as we know, over the last few years, it's been a series of lower highs and lower lows, but with some pretty strong intermittent rallies over a few weeks to a few months along the way, with, of course, the one that started at the beginning of 2026 being by far the strongest, right? And longest lasting as well, to the point where it seemed like this was a clear regime change until things, of course, cooled off with the US and Iran, at least with the worst case scenario being off the table. That's one of the reasons why XLE has started to come in and, of course, now start to underperform S&P 500, which we know is being powered by large cap tech. Regardless, it was a spike up, it was a crash down, but now over the last few weeks, a lot of back and forth movement, but again, lower lows and lower highs along the way. And so because of this, because of the slowdown, we're starting to see a slight but noticeable positive divergence in the 14-day RSI of this relative line. So again, if this unwind of large cap tech that we've been seeing now over the last few weeks here and there continues, the areas like this, regardless of what's going on overseas, could be an area of interest, again, from an absolute basis and relative basis. Now, absolute, the XLE still is in breakdown mode, still below that area, that bearish pattern is still alive. But let's not ignore the fact under the surface that we could be seeing some relative strength return versus the S&P 500 as well. So another underperformer, XLC Comm Services, of course, this all starts when a bullish pattern fails. So I wanted to show this because we had been talking about this potential for a while. In fact, this was one of the most interesting and compelling bullish formations that we had come across in 2026 up to this point because it had taken such a long time to play out. And along the way, we're always looking for good patterns, good bases, areas that look like they can break out, but more importantly, that we can gauge risk from, right? So when we're talking about chart trades for our clients, we're looking at formations like this: bullish patterns, inverse head and shoulders patterns, cup and handle patterns, flags, pennants, so forth and so on, because we think they could break out. But again, it's easier to manage risk knowing that there's some kind of support around here. But guess what? It looked good, never got the breakout. So this was, call it a failed pattern, or one that didn't even mature enough to get a breakout, but one that happens, right? Buyers that were being patient, trying to push this higher, of course, realized it wasn't going to work, and what's happened after that. Basically 2 or 3 weeks of straight downward movement. And so along the way, on a weekly basis, it wrecked also this very long trading range that had been in place really since the end of last summer. So we're going on 9 months, almost 10, 11, 12 months of this. And again, we've seen this before, multiple months of consolidation breaking out. Or along the way, of course, you had the failed breakout here in 2025, but with this one occurring and being unable to break down along the way, it seemed like potentially a really strong base continuation pattern taking place near the highs. And we were anticipating potentially with some capital coming out of the most extended names could be moving into areas like this. But of course, that has not happened. So now the question is the area of key support that it dropped back down to near this 106, 107 area enough to produce a bounce, right? Because we've seen it before, dropped down here in March, now right back down to it. Again, discouraging to see that, but finally getting back to some support that we can identify and potentially key off of for a short-term trade, also oversold for the same time as well. And so needless to say, it's been epic underperformance versus both the XLK ETF and the S&P 500. And we see how vivid these percentages were. And this is as of Monday, June 22nd, right? XLK up 33% from the beginning of 2026. S&P 500 9%, XLC down 9%. But again, it's not like it's been like this all year, right? It really started just 2 or 3 weeks into the comeback, where all three of them were, very close to one another near this break-even area. XLC was lagging by much, but right when the middle of April came and things really started to accelerate, of course, we know all the momentum went to AI and SMA, or AI and semiconductor related areas. Of course, that producing a huge run for XLK, where then XLK pulling the S&P 500 with it. XLC not coming along for the ride. So there's been a huge underperformance. And again, we saw that underneath the charts too, with the failed bullish pattern, with the long trading range being lost, and of course, momentum just coming out of this area. And so the question is, of course, is it time finally, because of all this, to see some positive action, both on an absolute and relative basis, into XLC? We just saw what the performance discrepancies look like. This is what it appears like on the XLC versus XLK relative chart, with making new lows all on the way, with this last big decline producing an even steeper one going all the way back. And this is a weekly chart. And so all the way down, the ratio was pinned to oversold. You can see how low it got, right? This was like around the 20s, high teens even. So new lows on both that relative basis versus the XLK, with the RSI hitting levels we haven't seen before either. So with the most recent push to new lows, just like what we saw with XLE S&P 500, failed to produce an oversold reading. This is a weekly basis, right? And so a positive divergence potentially with that. And again, if we start to see some of that, helium continuing to come out of XLK, then we can see some outperformance in the XLC. A lot has to happen for XLC to really look good technically, but if we're looking at areas that are really extended on either side, this ratio is definitely one of them. So lastly, let's look at the MAGS 7 ETF. And so let's just say it's teetering, right? This is a bearish pattern, of course. It's a bearish head and shoulders pattern with a downward sloping neckline. So when you have a situation like this and you have a downside break through a downward sloping neckline, it often produces a very identifiable air pocket of light support. And obviously that is the case, because on the way up, it was just gapping up, of course, led by large cap tech and growth along the way. So there's no support to key off of. Could MAGS find support itself or create new support? Yes. But, this is pretty ominous looking, especially if we have some rally attempts, they fail, more higher or more lower highs here, and then this becomes a potential to key off of. And, if you look at this, the downside target would be near 57, which is very close to the lows we saw from March. So, considering the names that are in here, if all those fall in unison, it's going to be very difficult, of course, for the S&P 500, for the NDX, for all the high-profile indices and ETFs that we track to hold things together. Now, again, this started with what? A failed bullish pattern. This looked even better than the XLC because of what? We already got the breakout, and we had a very good indication of how something like that played out back in 2025. Coming after the huge tariff tantrum, back up, gapped higher, broke out, and then that led to multiple months of uptrending action. So it'll look very similar to this, right? All of us starting near the lows once more. The pattern itself was much bigger from this perspective, but still identifiable. Right shoulder, breakout, but that only lasted for a few days, broke down a little bit, failed rally to get back above here. Then, of course, this is what happened. And now, as a result, all of this, again, is that bearish pattern we just looked at. So that's how it works out. Of course, on the reverse, we could have the same thing where a bearish pattern could fail and then produce another bullish pattern. But again, you can see how this has become messy, right? Where, these large moves, both within these individual ETFs, stocks, and the market in general, just causes breakouts to fail and potentially breakdowns to fail as well. And we'll see how that plays out too. So that has caused the MAGS 7 versus the S&P 500 to be oversold again. So the question is it time for a bounce because of it? And so here are all of the oversold conditions of MAGS versus the S&P 500 since the inception of the ETF, which, as we know, started in 2023. So not a lot of price action at all. So we can easily identify the times when this occurred in the past. And so we have these obviously periods here that were oversold, measuring this relative ratio, highlighted in red and blue. As we know, red indicates that did not mark the low, blue getting closer, or blue actually showing the last time that this indicator was oversold before things started to rally. And so it shows a few things. Number one, it tends to happen as this ratio is initially selling off, but the more oversold conditions you get, the closer we have gotten to getting a bottom here, right? So it occurred, say, in the last third of the decline in 2025, buying that last overbought or that last oversold condition, again, led to more downside action, but eventually turned higher. Now, again, recently, when it topped in late 2025, getting down to March, of course, just of this past year, oversold, finally getting oversold once more, but this time rallying from this uptrend line, very similar to what happened here in 2025. And now again, the second rollover, producing another oversold condition. That wasn't the right time to buy. Will this one be? We'll see. The difference right now is that, of course, that we are now below this uptrend line. So probably going to see, some efforts very soon to have another oversold condition like this bought, both on an absolute and relative basis. It's just a matter of where the follow through comes from right now. Because if you think about it, both the S&P 500, NDX, SMH, XLC, MAGS, there have been a lot of potential pattern breakouts and breakdowns. None of them have worked so far. So for that to change, one of two things needs to happen. We need to see strength being bought or weakness being sold. And that's what we'll be watching over the next few weeks. That's it for now. Don't forget to check out the rest of the videos we have on this channel, and talk to you soon.